impediments therein. He has worked with members of several committees and working groups formed by the Government of India and financial regulators to study the policy landscape and recommended necessary changes. Before joining Dwara Research, Dwijaraj has worked on the design of M&E systems for several departments of the government. He holds an MPP, which is a master's degree in public policy from the National Law School of India University at Bangalore. Dwijaraj, thank you so much for joining us, and we look forward to your talk.
Thank you, Professor, for the introduction. I hope I'm audible.
Yes, you are.
Great. Good morning, everyone. Before I begin, I'll just share my screen. I hope my screen's visible.
Yes, it is, Dwijaraj.
Right. Good morning, everyone. So before I begin, on behalf of Dwara Research, I would like to thank the organizers of the third Industry Conclave on Financial Analytics, and especially Professor Nandan for having us here. So at Dwara Research, I work with the Financial Systems Design Initiative. Introducing us briefly, Dwara Research is a mission-driven organization, and our aim is to build and further the vision of a well-functioning financial system for India that is built on three fundamental pillars: high quality origination, orderly risk transmission, and robust risk aggregation. Since 2008, when Dwara Research was founded, the Financial Systems Design Initiative has made several contributions to the Indian financial system and participated in strong formal engagements with multilateral organizations, financial sector regulators from several nations, the Government of India, and various financial services provider. In the past, we have been the technical secretariat to the RBI Committee on Comprehensive Financial Services for Small Businesses and Low-Income Households, which was chaired by Dr. Nachiket Moore. We have also contributed to various other bodies, including the FSLRC, the Committee of Experts on Data Protection, RBI's Interregulatory Working Group on FinTech and Digital Banking, Government of India's High-Powered Expert Committee on Urban Infrastructure and Services, the SEBI Working Group on Social Stock Exchanges, etc. So coming to the presentation is divided into two parts. The first part of the presentation, I'll be discussing the insights from two of our publications on an approach to monitor credit markets and detect over-indebtedness. I'm a co-author for both of these publications, along with my colleagues, Ms. Amulya Neelam and Dwijaraj. The second part of the presentation will cover machine learning techniques to detect over-indebtedness. This part will be presented by Ms. Anusha Kumar from IIT Madras. So coming to the presentation, the context in which we are having this discussion has a background where household indebtedness has become a significant concern in India, especially in certain select geographies, which include Assam, Karnataka, West Bengal. To give you an example of Assam, within 1 quarter, we have seen a 850 basis point increase in overdue loans from Q3 2019 to 20, where 0 plus DPD is days past due, where 0 plus DPD stood at just 1.5% of the portfolio. It now, in Q4 of 2019 and 20, it stood at 10%, which is an 850 basis point increase. Now, delinquency, which is what DPD comes up to measure as, delinquency measures are inadequate signals of over-indebtedness, as households experience financial distress to varying extent. And not all over-indebted households will be delinquent. In most cases, households undertake certain coping mechanisms like forfeiting a meal or taking their children out of schools, etc., before they even go to the stage of delinquency where they're not repaying their loans. Now, to be clear, we also understand that there can be instances of strategic default where an individual just doesn't pay, and that doesn't necessarily come out because of some over-indebtedness. But for this conversation, we exclude those cases, and we believe that almost all cases where we see delinquency is an outproduct of over-indebtedness. Further, once these consumer debt crises occur, we observe that there are several strong political headwinds that emerge, and that often create significant barriers for providers who are already operating in the state or who are willing to set up operations in that. And I think the classic example here would be the Andhra Pradesh microfinance crisis during 2010, where we saw this happen. And finally, the impact of COVID-19 remains uncertain given the massive loss of livelihood that we have seen across the nation. And with the debt moratorium and everything coming in, we believe that the impact is something that's only going to emerge in the coming quarters and hasn't completely emerged just yet. So we ask the question that what are the tools that may be adopted by the regulators to monitor the health of the credit markets in India and detect the prevalence of over-indebtedness. The approach we take in order to answer this research question is we study all 168 regular reporting formats that RBI uses to collect data from scheduled commercial banks and non-banking financial companies, NBFCs. So we study these regular reporting format and not the ad hoc request for data because these are systemic and structured input that RBI collects regularly, whereas the ad hoc requests are by definition ad hoc and therefore they do not really add to a systemic level, a systemic expertise or an institutional capacity building at the RBI. Then we also study the reporting that the SCBs and NBFCs do to credit information companies, that is the credit bureaus, and whether or not the RBI has access to such data. We study the literature on over-indebtedness as to how over-indebtedness is defined, what are the various features of over-indebtedness, what are the different stages in over-indebtedness. We study certain international jurisdictions, especially with the help of CGAP, which is a sister organization of World Bank, and see what exactly are different international jurisdictions doing in regard to monitoring the credit markets and over-indebtedness. All our findings are presented in a report titled Detecting Over-Indebtedness While Monitoring Credit Markets in India. And we also have a policy brief on the subject that looks at the implementation approach for this. Now, the name of the policy brief I haven't really mentioned here because it shares a very similar name with the report. So to avoid confusion, it's just the implementation approach that we discuss over there. Now, coming to the status quo, what exactly do we observe from our research is that presently the true understanding or the true picture of over-indebtedness is only with the borrower. Only the borrower knows the sacrifices she has made in order to repay on time, or the sacrifices she has made before even she starts to not repay. The providers who have extended credit to the borrower, on the other hand, has limited visibility over their own portfolio, what has been the interaction of the borrower in regard to the loan it has extended, and not necessarily in regard to the loan that other providers may have extended until and unless every month all providers are doing a credit bureau check. Now, most providers will also have a static data point with them, which is the income profile of the borrower at the time of disbursement. So take an example of a home loan, which is spread over, let's say, 20 years. The decision making where the income of the borrower was actually calculated was in year zero, where the income of the borrower was taken into account. But on year 19th of the loan repayment, the providers don't necessarily always know what is the income profile of the borrower, whether or not her serviceability, the debt serviceability is continuing, etc. Credit information companies, on the other hand, have visibility over all the loans that a borrower has. However, they do not have any data whatsoever when it comes to the debt serviceability of the borrower or the income profile of the borrower, etc. The regulator, which is the RBI in this case, has data in regard to what is the financial health of all the players in the system, specifically the providers, credit information company, etc., but does not really have an understanding of the underlying borrower profile. This is unique to India because in most other jurisdictions, we see the regulator going out and undertaking surveys to understand what exactly is happening at the grassroots, what's happening in the retail credit market. What we specifically find are that the RBI presently does not even capture data on fresh disbursements. What has been the credit extended to, say, sector A in geography B is in a given quarter. That data is simply not captured by the RBI. What the RBI does capture is the outstanding on a quarterly basis, but not the fresh disbursement. And we think that's a major problem with the present system. Secondly, the data captured for small loans are loans which have outstanding or principal amount less than INR 2 lakhs, does not allow for combined analysis. That is, the RBI cannot answer a question like how many credit card loans with a outstanding of say 1,80,000 has a floating rate of interest between say 3.5% or 3.8%. So combined analysis of more than two parameters is something that the RBI does not simply cannot do for small loans, which stands in contrast to large loans where the RBI can actually capture such data. Further, the data sought from NBFCs is severely limiting. At no point of time the RBI has oversight over which geography, which economic sector the NBFC is reporting to. Geography is simply not there. Economic sectors are there for certain select sectors, but not for all sectors. That's another lacuna that we find. Further, the RBI does not capture any data regarding the income profile of the end borrower. I think someone's mic's unmuted, so it would be great if you could. Okay. So right, the RBI does not capture any. Is the this okay? I'll just continue then. The RBI does not capture any data regarding the income profile of the end borrower, unlike various jurisdictions like Zambia and Peru, where the regulator actually captures the income profile of who the underlying and end borrower are. And in Peru, where providers are required to report to the credit bureaus the over-indebtedness status of their borrowers. So they have to identify whether the borrower is over-indebted, A, and B, report it to the credit bureau as a flag if the borrower is over-indebted. Finally, unlike most jurisdictions, specifically like the United States, almost the entirety of continental Europe, the UK, Singapore, etc., in India, we do not have a definition of over-indebtedness. What constitutes over-indebtedness, what are the various features of over-indebtedness, etc. We see that the RBI doesn't really have a definition to that effect. So what we exactly propose in this in the report is that there are 4 steps to the entire process. The first step is of monitoring of credit markets by recording select indicators. Now we propose a list of measures that will allow the regulator to monitor the health of the credit markets and identify malfunctions, if any. For example, if any specific geography is being overheated, if there is a specific product segment where we see a lot of fresh loans going out, or let's say, for example, you see a lot of gold loans being taken, then you know that there is some underlying underlying phenomena that's happening in a district where all of a sudden the number of gold loans have quadrupled or maybe tenfold increase overnight. So these features can be identified using the framework of indicators that we propose. I'll just discuss the indicator in an upcoming slide. The second step of the process is identification of potential over-indebtedness. Now, appropriate statistical tools, especially ML and AI-based tools, when deployed, will be able to estimate geographies or districts which have potentially high level of over-indebtedness. Now, over here, to be clear, the objective of the parameter is not to find if a household is over-indebted, but to estimate if there is a specific district in India where the incidence of over-indebtedness is maybe higher. So this directly links back to the context where we talk about certain geographies like Assam, West Bengal, Karnataka, etc., which are experiencing borrower distress. Because while household level distress is indeed a concern and the RBI should be looking at it, it is much more important perhaps to look at a systemic level of over-indebtedness and to ensure that policies are targeted in a manner that prevents such over-indebtedness. The third stage over here is validation of the over-indebtedness using demand-side surveys. So since the true understanding of over-indebtedness will always rest with the consumer, therefore to validate the insights obtained from the appropriate ML or AI-based tools, and to, of course, validate the tool in itself, surveys should be conducted to capture the true levels of over-indebtedness in a geography. And fourth is, of course, the final stage, which completes the circle, where you review the indicators to enhance their performance, adjust weights, etc. So what we recommend is basically a 4-phase can be split in 4 phases. The first phase is just a correctional phase. So over here, we are not proposing a new framework. We are not proposing any drastic change to anything. We are basically asking the RBI to, at the very least, start recording fresh disbursements at a district level from all providers, whether NBFCs, RRBs, SCBs, SFBs, anything, any and all providers should report fresh disbursements at a district level. The second thing we propose is the BSR 1B format to be redesigned along the lines of BSR 1A format. Now, the BSR 1B and 1A format, both of these capture the features of the loans given out by providers, specifically banks. Now, BSR 1A applies to all loans which are greater than 2 lakhs, and BSR 1B applies to all loans which are less than 2 lakhs. As I had already discussed, for loans less than 2 lakhs, the combined analysis for various features is not really possible. However, for BSR 1A, which is for larger loans, it is possible since the BSR 1A format records the data at an individual loan basis instead of some aggregate which BSR 1B does. So we believe that once BSR 1B is redesigned according to the BSR 1A format, it will provide the RBI with much richer data to go ahead and carry out much more meaningful analysis. The phase 2 and phase 3 are the enabling and operationalizing part of the framework. In phase 2, we believe that a approach to calculation of debt serviceability for reporting purposes only should be created by the RBI. Now, debt serviceability is a major indicator that we recommend that the RBI captures, where every borrower is assessed on whether or not a specific amount of debt is serviceable for her by taking a ratio of her income minus expenditure, which is to that of the the loan outstanding and the reservicing that they have to do. So debt serviceability, in a sense, would basically be a ratio of the disposable income to that of the debt service obligation. And we believe that this is something that A, all providers must calculate, and B, all providers must report, not on a loan by loan basis, but on a basis on an aggregate basis across the income segment. And I'll come to this specifically in the latter slide. Then we propose that subject-specific surveys, which the Financial Conduct Authority of the UK specifically does, uh, to be conducted. Now, these subject-specific surveys will basically look at a specific instance. So, for example, microfinance distress in, say, geography A, geography B, etc., or the prevalence of indebtedness in a income in an income segment of, let's say, 50 lakh to 50,000 to 1,50,000. So things like that. So it's very specific targeted surveys which look at what exactly is the feature of the underlying borrowers and not necessarily a secondary data that is being collected from providers. Phase 3 is where we ask the RBI to develop a uniform definition of over indebtedness in India, operationalize the framework and collect the data mentioned therein, and of course, aggregate the data thus generated. And in phase 4, we talk about designing and deployment of an algorithm to predict over indebtedness, and of course, commission more sample surveys to validate the result from the algorithm. Now, coming to what exactly is this framework of indicators? So we propose three broad levels of indicators. The first is of the market level indicators. The second would be provider level indicators, and third are borrower level indicators. So the market level indicators basically look at mismatches in credit to GDP ratios across various geographies and what has been the growth trend therein, and whether or not the markets are saturated. That is the number of players in the market, ratio of the borrowers served to the number of applicants, etc. Provider level indicators are basically the features of the provider's assets book, which is a corollary to what the borrower level indicators will capture. So over here, we look at the rate of growth of lenders' asset book, disbursements, or lack thereof to new to credit borrowers, increase in advances unaccompanied by expansion into new geographies, renegotiation of credit contracts, number and nature of complaints that are received by the internal ombudsperson or grievance redressal or complaint cell of the provider, total number of loans per borrower or applicant, and its distribution. So basically, how many applicants are there with just one loan, with 3 loans, with 10 loans, etc. Now, coming to borrower level indicator. So the first thing that we capture or we propose that the RBI should capture is average outstanding and installments per borrower. So what is the average outstanding at an individual level? This is a data that is already available, but this is not something which is available at a granular level across specific districts. We propose that this should be collected across districts, number one. Number two, income profile based DSR distribution. So this is where the primary data point that we would ideally want to rely on while uh, creating the algorithm comes from. So income profile based DSR distribution will basically look at what is the debt serviceability ratio of various borrowers across income segment. Let's say there are 10 deciles of income segments. So within decile 1, what is the average DSR of all the borrowers from a specific geography? Decile 2, decile 3, so on and so forth. So this is what we believe will be a leading indicator of borrower distress, because if a debt is not serviceable, the likelihood of the borrower going into over indebtedness is very high. And once the borrower goes into over indebtedness, the likelihood of default increases significantly. Anecdotally, we know that the moment the debt service obligation for microfinance borrowers increase beyond, say, 3,000 rupees a month, that is where the rate of default start to increase dramatically. So we believe that this will be a major factor or a major indicator which goes into modeling and predicting over indebtedness. Then we look at number of insolvency and bankruptcy cases in a region. Of course, these are uh, lagging indicators insofar as that over indebtedness must have occurred before a default, and once a default occurs, then only you go to IBC. So we believe that this is, although it's a lagging indicator, the fact is that if there are maybe an increase in number of bankruptcy cases in a region, the likelihood that there are perhaps other borrowers in the region who are also facing distress is sort of high. Then we look at the number and nature of complaints to RBI ombudsperson and qualitative indicators on borrower distress, which is something we want to collect through various demand side surveys. So the implementation roadmap we propose spans approximately 2 years, where for the first 1 year, we basically go through the first phase that focuses solely on correction to existing reporting paradigm, and the second and third phases which enable the development of the algorithm. So during these first 12 months, what we believe will happen is that number one, the data that the RBI collects will provide training data for the for the algorithms that the RBI should develop, and B, provide primary data for also validation of the insights obtained from the first round of, say, the first set of algorithms that may be developed. The fourth phase marks the design and deployment of an algorithm where observable indicators like DSR, debt service ratio, are used to estimate hidden parameters like over indebtedness. Now, the next part of the presentation focuses primarily on the ML and AI based techniques through which observable data point like delinquency and rates of default may be transformed into an estimate of unobservable parameters like over indebtedness. So I would request Anusha to basically walk you through the next part of the presentation. Anusha.
Thank you, Dwijaraj. So I'll just share my screen. So I hope my screen is visible and my audio is clear. So good morning, everyone. I'm Anusha Kumar, a research scholar from IIT Madras, and I'm going to talk about how machine learning techniques can be used to predict over indebtedness. So this work is done as a collaboration between Dwara and IIT Madras. And specifically, I'm going to talk about a sequential modeling framework for detecting household over indebtedness. So the authors from IIT Madras are Kaushik Bhatt, myself, and Professor Nandan Sudarshan. So, the motivation and the primary objective of microfinance is improving the financial well being of households. But detecting financial distress or over indebtedness has many challenges, like the limited credit history and the subjective nature of financial distress. So, this makes it difficult to quantify the over indebtedness as such. So, using delinquency as an indicator, we propose a framework to address the risk of over indebtedness, to detect delinquency and the financial distress of households. So, in order to capture the difference between delinquency and distress, we use a semi supervised learning approach known as the positive and unlabeled learning or PU learning to model the financial distress. So, in a PO learning setting, we have a positive class and an unlabeled class. So the unlabeled class may contain data points from both positive and non-positive classes, whereby non-positive, we also call them as negative class. So the aim is to classify the unlabeled set into positive and negative classes. So in our current conceptualization of the model, we consider the set of all delinquent households as the positive class and the set of all non-delinquent households as the unlabeled class. And this is because all delinquent households would be intuitively under distress, but non-delinquent households may or may not be under distress, and so we consider them as the unlabeled class. So the Dwara KGFS dataset is used to study the quarterly behavior of households. This dataset has a financial history of around 2 lakh households, and it has features such as the number of active loans, closed loans, annual income, expense, and other demographic features, etc. So, and we consider a household as being tagged as delinquent if the days past due on its loans is 5 or more. So for model validation, we use the Dwara CGAP survey data, uh, which is a survey data of around 400 households. And this data set is different from the KGFS data set. It consists of some indicators of over-indebtedness, like self-reported delinquency, low essential consumption, sale of assets, churn, etc. So we basically use these for tagging households as distressed while validating and fine-tuning our models. So in order to match both these data sets, we use the k nearest neighbors algorithm to map the households and to find proxy households in the training data set. We extracted the data of households which belonged to the same district and the time frame from the KGFS data set so that we have households which have similar characteristics. So mainly in terms of income, expense, demographic features as the households from the CGAP survey data. So we used the k-nearest neighbors algorithm on the features of the two data sets to pick the closest households. So moving on to the methods used. The first method is our baseline model, a delinquency predictor using recurrent neural networks. So we model the temporal nature of the data by using 10 quarters of information to predict the delinquency status of a household in the 11th and 12th quarters. So the final model used is a combination of long short-term memory, or LSTM in short, gated recurrent unit, or GRU, and some merge layers. And we use binary cross entropy as the cost function. So in this model, we cannot ensure that when a particular household is delinquent, the probability of distress would be close to 1. So we define a new cost function as shown here that forces the model to predict over indebtedness for a delinquent household. So that is where this B is equal to 0. So this also helps in identifying non-delinquent households that show signs of distress. So a penalty term is added where lambda is the penalty parameter, D is the delinquency status of the household at the end of 10 quarters, and P is the probability of distress. So the other model we propose is denoising autoencoders. We can use this to visualize the paths taken by both delinquent and non-delinquent households over the time steps. So k-means clustering was employed to cluster the projected space of the last time step activations to segment the data into groups. And for each group, the density distribution of the delinquent customers were considered, and the group with high density of delinquent customers were tagged as households in financial distress. So finally presenting the results here. So the baseline models are good in predicting delinquency, but not financial distress. The proposed biased RNN model that we had with the new cost function offers a significant improvement over the base model in predicting distress. So as we can see in this table, when considering non-delinquent households, We can see an improvement in the class 1 recall and the F1 scores of the biased RNN model, and a slight improvement in the performance is noticed when the autoencoder based clustering model is used to predict over-indebtedness. So, thus, the use of a PU learning framework enables us to model financial distress, and it increases the predictive accuracy of the model. And hence, this validates our hypothesis of the study that delinquency can be considered as a subset of financial distress. So, I now request Dwijaraj to please conclude the talk.
Thank you, Anusha. So if you could just move to, right. So we believe that there are 5 fundamental benefits that sort of come from the approach that we propose. The first is an improvement in the market monitoring capacity because A, we are collecting more granular data, and B, we are allowing for a combined analysis of several parameters to be feasible from such data being collected. Secondly, the unit of analysis we propose is that of a geography instead of a household. Like Anusha mentioned, her analysis focused on predicting household level over indebtedness, whereas over here, we believe that the appropriate level of analysis would be a geography to begin with, because of A, the manageable data volumes will be collected. B, regulatory overreach, where individual level, household level data being collected by the RBI is avoided. And C, just because you're avoiding collection of individual level and household level data, what you essentially end up doing is safeguarding privacy for a lot of the borrowers. Third is that we believe that the RBI's dual mandate of ensuring systemic stability and of allowing consumer protection is addressed. Systemic stability, I believe, is a fairly obvious point, because once you avoid over indebtedness by allowing or rather designing policies to combat over indebtedness in a very targeted manner, would would basically reduce the probability of default for most of the loan books of providers, and therefore ensure systemic stability. At the same time, consumer protection, because overburdening of consumer due to a lot of debt stress is avoided. Fourth, we believe that the privacy concerns are mitigated because once stringent privacy standards are adopted, which we do propose in the reports, we don't think that privacy will become a major concern. Plus, the fact that all of the data is aggregated average, which in itself anonymizes users, will be a step forward in ensuring that privacy is taken care of. And finally, we believe that the cost of compliance is going to be minimal because most of the data we are proposing is already captured by providers, barring debt service DSR, debt serviceability ratio. And a lot of the data is already also being reported to credit bureaus. So the cost of compliance of reporting such data to the RBI is expected to be minimal. And therefore, the RBI, we believe, can operationalize the framework in record times. So I think we'll open up to questions. And in case you want to write to us, we have mentioned our email ID, so please feel free to write to us as well. Thank you.
Great. Thank you so much, Dwijaraj. I hope I'm audible. I've collated a couple of questions from the chats. So the first question, I think multiple people have asked this, is how you talk a little bit about an organization having only a limited view because of the fact that unless you're on a monthly credit reporting cycle, you don't know the equation that the customer has with other credit sources. But even this, how is this going to dovetail with the whole informal lending sector, which is a huge component of lending in these spaces? I mean, is there even any light in the end of the tunnel there? And what have you seen in terms of markers or indicators of high and low levels at a systemic scale from the informal lending sector?
Thank you, Professor. I believe it's a wonderful question, and this is something we did struggle with ourselves because we understand that it's next to impossible to capture the entire gamut of informal lending that happens, because not all informal lendings are even from, say, professional money lenders, but often from friends and family and from various other sources that possibly we cannot always capture? So I would believe that there are two parts to this answer. So one would be that some of this data is actually going to get captured the moment we go for surveys, demand side surveys, where we not only rely on the information provided by providers to the RBI, but also the information that is reported by the borrowers themselves. So over there is a good scope of capturing informal debt. But again, at no point of time can we be certain, because in most cases loan contracts are not there. So what is the quantum of the data? How reliable is the data being reported by the borrower? That bit remains slightly uncertain. Second part, at a systemic level, I think we are seeing a gradual decrease and in the share that informal lending has. So we believe that going forward, that is going to come down, and therefore most of the data we collect from the formal sources will actually encompass the majority of the debt held by households. However, in the meanwhile, we believe that yes, that is a concern, that informal data is not something that we are capturing.
So I had a follow-up question entirely from what you were mentioning. You were mentioning two sources of informal lending, right? So there is the traditional loan, lender, and then there are other sources which you said are virtually impossible, like families and so on. And to what extent is it important to have such a broad definition of informal lending in light of the fact that uh, some sources charge an interest and the others don't, and to that extent its implication on over indebtedness is vastly different, wouldn't you say?
Yes, Professor, I'll agree with you that in terms of interest, yes, there is an implication that professional money lenders will be charging interest, and therefore over indebtedness is perhaps more likely over there. But I think another major feature of over indebtedness is just psychological distress that people face. So, for example, even if I borrow some money from my friends and family that I'm unable to return, whether with interest or without interest, the very fact that they tomorrow can ask me for that money back can cause psychological impediments and can cause fractures in the social fabric. And I think that's pretty much, I won't say this is the fundamental idea behind microfinance, but social capital is what microfinance also sort of capitalizes on, that is an intangible value that individuals would want to hold dear to. So this intangible value of having friends and family and being able to repay them also comes to force, and therefore we believe that even friends and family should be a part of informal money lending, because even though they are not charging interest, there can be psychological imped, or there can be like psychological ramifications in case they are, the borrower is unable to repay.
Got it. So I just wanted to dig a little bit more on one source of data that you spoke about, which is surveys, right? So this becomes fairly instrumental given the nature, especially of, normally we have a sense of data hierarchy where surveys are often seen as being more noisy, prone to cognitive biases, but it almost looks like here it's inevitable in some sense to get a full understanding of the problem. Specifically, what is the role that you see that surveys can play between, say, validation, right? So you have a model, you have this notion of informal lending, you have what you can observe, and then what is behind. And so there is a good amount of role that I can see surveys playing on validation. But to what extent could it scale up as the primary data source itself for making decisions at an individual level?
Right. So we don't expect the surveys to be the primary decision-making parameter. So we think that the primary decision-making parameter will basically be from the secondary sources, the administrative data that RBI collects from providers. But whether or not the decision is good, whether or not the classification of a geography as potentially overheated or not overheated. So the validation for that, to understand whether or not the tools created, the approach adopted by the RBI is good enough, I think that comes from the surveys. And you're right, Professor, that there will be a lot of noise and there are certain barriers that are inherent to surveys. But I think it's a trade-off, because one would be to believe that whatever algorithms we have created is perfect and it predicts accurately. And it's basically just having faith in the design and just going ahead with it without any empirical evidence that it is good enough. So we believe that the surveys despite its limitation, actually allows us to go a step further and empirically establish the efficacy of the instruments designed to detect whether or not over-indebtedness is present in a geography.
Got it. Got it. So one other question that's come up is, a lot of this, a lot of what you said about over-indebtedness, either through the medium of surveys or through observational and transactional data, seem to be more leading towards the notion of a good metric or a good indicator of over-indebtedness at a systemic scale, not at an individual scale, but you're talking about a geographic region. So to what extent can I take that and translate that to the scopes for intervention, right? Because some of this, one might argue, is just another, it's an indicator and it has no causal bearing on financial well-being per se. So for instance, if there is a famine or a flood or something like that, which is systemic, sure, you're going to see these indicators of over-indebtedness, but it doesn't leave you with too many levers in terms of intervention. So how do you see, what do you see as the role for interventions through a study like yours?
Right. So I think this is something we do cover in the report. So presently, so it will be slightly a longer answer. So what happens presently is that the RBI, especially in the microfinance lending guidelines, mentions that one of the roles for the microfinance institution is to minimize the level of over-indebtedness of the borrower. And in order to do so, it basically prescribes two aspects. One, that there is a loan cap limit that you cannot lend. A borrower cannot have more than three loans from MFIs. The second is that you cannot lend to a borrower who has an income, say, of greater than 1,50,000. To the best of my recollection, that's the number. That number might be 1,80,000 after the present revision to the circular. However, the point is that these are severely limiting, and these restrictions don't really apply universally. So while an MFI cannot be the third lender to a borrower, a bank can lend to them, a non-MFI NBFC can lend to them. So anybody and everybody can lend to them. So the problem of over-indebtedness right now is so the RBI is trying to tackle the problem of over-indebtedness through just one channel, which is of microfinance. We believe once these indicators are present with the RBI and the RBI is able to understand that, okay, geography A has potential over-indebtedness. Now, at the same time, the RBI also has knowledge of the fact that there may be certain precipitating factor behind that over-indebtedness, whether it's a famine or a natural disaster or other factors like that. So we believe, of course, that's a human judgment that the RBI can take at the moment, that we don't think this is a systemic issue, but rather it's an outproduct of a shock event. However, when there are systemic issues, then what is the transmission channel for this over-indebtedness? Which are the lenders who are over-lending? Which are the product segments where we are seeing over-indebtedness? Why are we seeing these over-indebtedness? So these data come from these insights will come from the analysis that we propose. And once that comes in, so the RBI therefore can then have much more tailored tools to attack just a specific root cause of the issue, the specific channel through which indebtedness is happening, the specific product segment, etc. Because if you look at what's happening in Assam right now, you're basically restricting lending to a certain degree. So if I'm to take just that policy lever of restricting lending to a certain degree, and then we are able to very specifically target the product segment or the transmission channel, then I think the efficacy of the policy increases, and other borrowers don't really suffer, because until you can't have a nationwide policy, because the needs of every specific geography is going to be different.
Understood. I guess a very quick follow-up question someone has had is, if lending is bifurcated geographically, to what extent are we saying that certain areas are just prone to delinquency because of the nature of it being a specific geographic region, versus the existence of specific players or certain specific policies? Or is it even worth distinguishing at your side to say that you're looking at these indicators, but these indicators are more reflective of it being the demography and the geography or the cultural practices, versus no, this is because of a policy?
Right. So we are not sure about so when you say policy, you mean like national level policy by the RBI, etc., or do you mean lending policies by specific
And
institution?
yeah, a lending policy could mean the number of lending centers that a
Right.
particular MFI has or something
Right,
like
right,
that.
right. So I think it's not an either or supposition in our
Mhm,
framework. So if you
mhm,
remember that we had basically talked about three levels of indicators. One is a market level indicator, one is a provider
mhm,
level indicator, and one is a borrower level indicator. So we
mhm,
believe that the incidence of over indebtedness will occur because of multiple factors,
mhm,
like the policies of the providers as well, which is why we are actually capturing provider level data, as well as say cultural and geographical features that are unique to that unique to customers in a specific region. So we
mhm.
believe that it is going to be an amalgamation of all of the three factors, and it'll be difficult for us to distinguish and say that geography is the predominant factor or providers are the predominant factor, which is why we
Mhm.
are taking all of these into account when we are analyzing whether or not a specific geography. So at the end of the day, the geography is the unit which is getting classified, but the input on the basis of which this classification is happening is not necessarily just geographical, but also includes data regarding providers and the behaviors of the providers.
Got it. Got it. One, a kind of final question on this. I mean, perhaps maybe Anusha might be able to help with this answer as well. What is really the interpretability of the PU model suggested to classify over-indebted but not delinquent borrower?
Yes, thank you, Professor. So, I think the main interpretability coming out from the PU learning model is that we will be able to see some differences between those non-delinquent households that are being predicted as
Mhm,
distressed and are predicted as financially healthy. And the main indicators
mhm,
might come out from, let's say, the annual income of that particular household or the annual expense, the days past due mainly, and other such comparisons between the mean values or the average values can also be taken from the number of active loans that that particular household has taken in that quarter. And for instance, even the EMI. So I think those would be good indicators that we can use to interpret the models that we have with the recurrent neural networks.
got it. Okay, so one last question. To what extent, Dwijaraj, do you see? I mean, a lot of what we've spoken about in terms of indicators seems to be one of, oversupply or undersupply of credit in some sense and not hitting a sweet spot in terms of credit. To what extent, and I know we might not have the answers to it yet because we don't have a very clear metric of distress. But to what extent is it product suitability versus just supply of credit as being too much or too less?
Right. I think that's a very pertinent and a very important question that we are actually trying to answer as
Mhm,
well. Not only through this piece of research, but overall otherwise, because one of the fundamental pillars that Dwara research believes in is suitability of credit. That
mhm,
not all credit is suitable for everyone. So we should always ensure that suitability of credit is measured. But to answer the specific question, I think an oversupply of credit is not necessarily unsuitable or an undersupply being unsuitable. To give you an example, I think one of our studies actually concluded that in Chennai, the credit to GDP ratio stands at 400%, whereas in the interior districts of Tamil Nadu, the credit to GDP ratio is somewhere close to 35%. So there is a lot of regional disparity. Now, there are multiple factors leading to that. But without going into that, I think yes, in areas where there is oversaturation of credit, or where
mhm,
people are getting credit much more easily than otherwise,
mhm,
it creates a problem in regard to the access to credit for the underserved geography. But
mhm,
in areas which are not underserved, I think suitability becomes the first factor through which, or unsuitable products or unsuitable lendings become the first pathway through which over indebtedness occur. And I think one of the primary approaches to detecting suitability of credit is through the debt service capacity ratio, whether or not a debt is even serviceable by the borrower. And I think I would just like to add slightly on this. So traditionally, debt service capacity is assessed for a lot of products like a credit card, a housing loan, a car loan. They will assess what is your income profile, whether or not an individual can go ahead and service the debt in the coming months. However, for a lot of product segments where the security is liquid, say for example, loans against gold or loans against mutual fund or securities, there is no debt serviceability that is being assessed because the provider believes that, okay, even if the borrower defaults, I have this very liquid security. I'm going to liquidate this, and my loss given default, sure, the probability of default may be 100%, but my loss given default is 0% because my entire exposure is covered by the underlying security. So we think these factors should come in, and debt serviceability as a measure of suitability should definitely be operationalized by the RBI going forward.
Got it. Got it.
That answers the question.
Yeah, it definitely does, Dwijaraj. Thank you so much for a very interesting talk.
Thank you, Professor.
Again, and again, there are more questions that are trickling in on the Q&A. So please, if you have a few moments to kind of review them, maybe you can answer them on one-off basis and so on. That would be great.
Certainly, Professor. Thank you.
Great. Thank you, Dwijaraj.